Dmitry Zaytsev is here. Dmitry, welcome back.
Happy to be here as always, James.
Tell me what you're buying, what you're liking, what you're selling, what you're hating.
Yeah, we're accelerating this process, aren't we?
That's right.
This whole interview thing. I mean, I bought a bunch of Canopy around a week and a half ago, but nowhere near the kind of allocation I wanted for a longer term position. So maybe only 20 to 30% of what I was looking for before this move started going. So very nice move. Right now, I've sort of scaled out a lot of that. Why? We just rallied way too far, too fast, in my opinion. And for that diversity's sake, I bought a little bit of puts.
Wow. Okay, so that's hedging your bets.
Well, I've scaled out of those positions that I had earlier. I also wrote puts before, and I was doing that way more aggressively, like the last week or two or three. And so all of those things just decayed to zero, which was good because I wrote them. And so I bought them back for very cheap, and that worked out. But as always, you always wish you did a little bit more.
Right.
Right.
Okay, so tell me, what's your take on the whole Aphria announcement today? 22 cents a share in earnings, plus Vic is hitting the road. So
I don't know if the NDI or whatever we have here is linked up, but if the control room, yeah, there we go. Okay, so we got some numbers here. Cool. I thought it was surprising, generally speaking, that, or at least it goes to show what the market is thinking when Vic is going to be phased out and coal is going to be phased out, and on what I see as relatively disappointing numbers, in my opinion, that the stock rallies a lot.
So do you think that the stock's rallying because Vic and coal are on the way out the door as opposed to in reaction to the earnings?
Yeah, absolutely. That's what I think is happening.
And why do you think the earnings are no good? 22 cents a share, that's nothing to sneeze at.
Yeah, so I mean, you guys were just talking about this, but I don't know if it shows here, but yeah, so a good chunk of that, 75 million or so, is from gain or loss from equity investees and gain on long-term investments. Something that kind of concerned me when I was looking at this is, just from their highlights here from the MD&A, is the fact that they burned through over $100 million of cash in a quarter. So if you see here, right around the 313, 184, and you'd be thinking they're building out their facility and all of that, but there's still a while, I think, before that's really fully completed. I think it's completed, but their internal wiring and all that is still sort of in process, as I understand it. And I think they also they don't have a grow license for it yet, and there's no sales license either. So I think it's going to be a little more delayed than previously guided, which I think is a little bit of an issue as well. As far as I understood it in my quick little morning look at it.
You caught more than I did, that's for sure. Okay, so then you think that this rally that has sort of characterized the market since the beginning of the year is over effusive? You don't think it's got legs? You don't think it's going to keep going? Well, so if you look at the chart, the first chart I brought along here as well, it's just the Canopy chart from, there it is. This is a pretty big break. There's some really solid volume behind this move, and I think this is just U.S. institutional or retail investors after the Constellation and Piper Jeffries, I guess, initiation of coverage. And you got a big move. Part of it is definitely short covering. There's a lot of shorts that were in here, and I've been short, I've been long. Most traders are as well. To get greedy enough to be staying in a short position when it's in the mid 30s already, getting to the low 30s, especially when a good chunk of their balance sheet is cash. Yeah, I think that's just a little greedy. And as we've spoken on the program previously, I think the names you want to keep are Canopy and a very few select other Canadian names, and the rest you should focus on, ancillary and US and very niche sort of plays that you've done a lot of due diligence on. And you know what, Canopy, I think, I don't know if Aurora's caught up to them yet, but I think Canopy is the top performer in terms of the larger cap stocks in the recent couple of weeks. Sure. What about Tilray?
I haven't looked at them too much. I think there was an announcement today where Privateer Holdings is going to delay the unlock, but and I think that's why they rallied when I was looking at it at pre-market, which it's interesting, but I'd like to see more of the numbers come out for a lot of these names. I think the Canadian market is not as hot as everyone thinks it's going to be. And only a few players will really do a good job. So just going back to even the breakdown here of the revenues,
So 21 million net. I think last quarter they had 13 or something. So only about $8 million of revenue from a month and a half of rec, in essence, right? I could be wrong. Like I have to review this. This was early morning before work, right? But some of the other things I'm looking at here is the general and administrative expenses. So as well as selling, marketing, all of that. Kind of surprising that R&D is only $600,000 for the quarter.
That was Aphria, or that was Canopy?
No, this is all Aphria, yeah.
Okay.
This is from today. This is fresh from this morning.
Right.
And this is just a breakdown of that SG&A. So kind of what I think a lot of analysts are trying to understand, and investors, what they're trying to understand is what the real run rate when this company actually scales up, what's the actual run rate going to be, and what are these margins going to be. So what you'd be looking at is the operating margins after all of the operating expenses, which is currently negative, which is negative 21 million right now. Trying to understand that a little bit better, and the dollar per gram costs and all of this stuff. It doesn't really matter right now, and it's a bad number right now, but you really have to do a little bit more work to try and understand what the steady state expense line items look like.
Yeah.
And so all of these 22 cent or whatever gains on investment, that's not like a sustainable long-term sort of strategy.
Sure. In addition to the $100 million burn, there is an increase in debt from 140 at May 31st to 302 million as of November 30th, which is like, what?
Yeah.
I mean, so is the spend that we saw coming in the form of debt, or is that from cash on hand? I mean,
clearly it's both. Clearly it's both. Right. And I think a lot of these names, they're really running. At this rate, Aphria is only going to have another 3 to 5 months of cash, right? If they continue spending it like this. And as you've seen, the sales numbers, even if it's that was only a month and a half, aren't that impressive. And it's true that the OCS and other producers had issues as well, right? I think Aphria had a labeling issue where they had people licking the stamps or something like that.
Well, that was common, I heard.
Yeah. So hopefully that will improve the numbers. And there's edibles, there's stores, there's a rollout. But you know what? Of the 5 people that I know that were buying from the illicit market, I think only one of them or 2 of them have tried, and one of them sort of switched off to the legal market. And so the numbers that I was looking at, you can find it online. They have their own online stores, a lot of these illegal dispensaries, and their prices are pretty good. They're like their AAA, 5A, whatever bud, 1 ounce is at the most expensive stuff that they have is at the lowest end of what OCS has.
Sure.
In terms of pricing. So I think it's a hard sell for now. And so
do you think then that the Green Growth Brands buyout of Aphria at $11 is going to be sort of like a coup de grace that might actually breathe new life into the whole Aphria value proposition while transforming Green Growth into now becoming that big brand royalty company that it envisions becoming based on its past association?
Yeah, I think Aphria used to be a very interesting and strong story a year ago or so, and now it's become a dumpster fire. And this Green Growth Brands thing is, it's great that they're raising that $300 million or whatever, but it's just, they're going to need it for I think, all the expenses and, new investments and ventures that they're going to have to go through.
Right.
And it'll be very interesting to see that as we sort of see consumers choose brands that they like, companies that they like, we'll see, I think a lot of interest from investors really dry up for a lot of these other companies, and so like in all kind of booms and busts, you're going to have some names dry up. Not saying Aphria specifically, let's say, but capital markets are cyclical, and I think we get to actually see what the cash flows look like. And then people will start basing decisions on that. Think about it. What are the catalysts now? There's really the U.S. expansion, right? And I had a chance to speak with some of the, actually, 1 or 2 people from the management teams of some of the large MSOs this week. And they're doing some very impressive numbers. They're doing some very impressive things there. I encourage everybody to take a look at the U.S. names.
And which ones in particular? Curaleaf, I know, is targeting $225 million run rate.
Oh, I think it's even more for 2019.
Okay.
But like the Ianthus, Curaleaf, Acreage, Green Thumb. Just some
Ianthus
names.
is an interesting name. You know, there's one that really hasn't rebounded from the tax loss discount that kicked in at the in Q4 2018. Why is Ianthus not sort of demonstrating sort of a participation in the herd movement to the upside?
I think Ianthus has been around a long time, so it doesn't have that same excitement factor. I think you're giving too much credence to retail investors and how they look at some of these names. I think over time, especially in 2019, as the revenues from the U.S. really start coming on, and you're going to get to compare companies' valuation, whether they're EV to sales or EV to EBITDA. I think Ianthus is definitely one of those stocks that will do really well in that kind of environment. One thing I will caution, though, and I don't think too many people know about this, but in the U.S. there's something called 280E. So it's the IRS code there, which says you can't deduct and claim tax credits on the sale of a Schedule 1 or 2 substance, which cannabis currently is. And I'm not saying that this is something permanent, but it's just something that's going to really hurt margins for a lot of these names. And so if the company you're looking at has a very large retail dispensary type presence or makeup of their revenue, that may not actually translate to as much EBITDA as you hope it would for the next couple of years. Probably.
I noticed in the listing statement of Acreage that the structure of their acquisitions was such that it was designed to circumvent the negative implication of 280E in that they were offloading those things into separate vehicles.
Yeah, SPVs and stuff like that. I mean, I'm sure that's definitely one way to do it. And I don't know how much you want to play around with the IRS in terms of this. But sorry, going back to Canopy and all these big moves, like one of the reasons I like Canopy is they have a significant amount of cash. They won't need to dilute themselves. And as the U.S. sort of starts opening up, they'll be able to deploy that capital, whereas for other names, maybe they won't be able to raise as favorable multiples. So another chart actually, and it didn't load quite properly, but I'd like to put it up here. I didn't update it until recently, until this big move started happening, but it might be a little bit of a complex chart. But in essence, what you have in blue on the left here, the Canopy's price over the last year or so, let's call it. And on the right is a moving average of open interest of calls and puts. So this is just a ratio. So for example, here at 1, so roughly, I don't know if my mouse is on there, I don't think it is, but roughly around 1 is when there's as many calls written as there are puts, right? And so what this kind of shows, for example, currently this line is really up there, so it's around 2.5, 3.
So that's the ratio of calls to puts?
To puts. In all strikes, at all expiries. So what's interesting about this, it means there's 3 times more calls created than puts.
That indicates bullishness.
So I would argue yes, and the reason why is because I think there's not a lot of option sellers that go into the market to actually sell. I think there's a lot of retail option buying, and the banks, they're just market making them. So if you look at this chart, once again, if you pop it back up, what you see is around the periods where you had big declines or big rises, you see that ratio sort of move back in. So for example, before the Constellation deal, you saw this really big rally of all these people buying more calls than they were buying puts. And then as you sort of had that rally going into October 17th, you saw that number sort of stabilize. And this is a 20-day moving average. So it smooths it out a little bit, just that way, as opposed to being all over the place. And so recently, if I had checked this and updated this chart, there was a really intense amount of buying in terms of call options versus put options. So if you see the ramp earlier on the chart, they're closer to the end, and that could have presaged this big move that we saw. Technically, you saw a lot of good things line up in the last week or two. Equity markets stabilized, Powell, further came off, and sentiment really improved. And so we were sort of in this good move where there's a lot of bearishness and short interest that was just ready to be squeezed out. So that's why I think we had this big move.
Okay, so the ebullience in the cannabis sector has been, in large part, I'm sure you would agree, driven by broad market strength. We saw the price of oil coming back. The S&P has delivered, I think, 8 positive sessions in a row now. Is this trend, is this effusiveness in the cannabis sector, is it reliant 100% on the broader market movements, or is it in some degree non-correlated to the broader market movements? I mean, if we look at the Q4, we saw it was very closely correlated to the broad market. But in Q1 2019, we're seeing cannabis have much bigger moves to the upside than does the broader market.
Yeah, I would just say that cannabis really in the last, until these last 3-4 days or so, has actually underperformed the broader market. And you would think a high risk, high growth segment like cannabis, you would think it would have a much higher beta, and so it would actually rise 2 to 3 times faster than the market. So I feel like cannabis is just playing catch up right now. Generally speaking, during sell-offs, correlations increase between asset classes, and all that really means is just when everything's going to shit, it all just collapses together. But when markets are stable, or they're in this small uptrend, maybe not huge bullishness, sort of each sector takes a life of its own, and that it's more driven by, I think, news and more, I won't say fundamental, but sector specific
headline catalysts.
Headline catalysts. Well, which I guess cannabis, that's the fuel that's been driving that.
Sure. Okay. So then, what is your macro strategy in 2019?
Yeah, so I mean, I think this rally, and why I'm not getting super bullish or anything right now, I think this rally in the S&P 500 is done for now in the very short term. So we're talking like next couple of weeks. I could be wrong. Let's see. I think a lot of people, were a little scared, a little shaken after that December run we had there. And some of the numbers I saw and things I heard was a lot of the retailers missed yesterday. So they talked about guidance. And what's interesting is the consumer in the U.S. was spending aggressively through like November and the holiday season, but for some reason it seems like around December they really slowed down their purchases. And this could be just due to the wealth effect. So if you have an IRA, or you have in Canada TFSA or whatever, and you see your stocks dropping, your net worth dropping by 20%, you say, yeah, maybe I shouldn't get that $1,000 thing I really wanted to get on credit today. And so that could have a feedback effect. So generally speaking, what's my macro strategy? That was your question. I think it's great that cannabis, or some of the key kind of names, have broken out. As we've been talking, it was time in the last couple of weeks to really start scaling in. Now I think you wait, you let things kind of consolidate a little bit, see how the next couple of quarter of the other LPs pans out. I think have some more exposure if there's any kind of rollover this next couple of weeks. Buy some of the names you like, and I think really beyond a few names in Canada that you really understand and like their story, I would really focus on the U.S.
Okay, Dmitry, that's great as usual. We'll come back to you next week. Thanks very much.